Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
Welcome to Stockwatch with me and Taoleng Lechela. Joining me to unpack your stock-related questions today are Grant Nader from Benguela Global Fund Managers and Shane Watkins from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41312 or 41392, or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for your time this evening. Let's start in the US, right? It seemed like that AI sell-off had hit the brakes, but we are seeing some losses coming through today, particularly in NVIDIA after SoftBank sold its stake in the chip maker. Grant, how are you reading this? Does SoftBank think NVIDIA is fully valued, or does the group is the group simply just taking some profits and investing or rotating it in other AI investments?
Yeah, look, I'm not super close to SoftBank. From what I understand, they are more of a VC, private equity style investor. They tend to invest early when they can, help the company scale up, pump in capital, monetize it, and then, to me, this is taking money off the table and feeding that into other exciting growth opportunities. I don't think it's a reflection on NVIDIA per se, but we all know NVIDIA has had an unbelievable run, and so there's probably better exciting opportunities for them that are small with the ability to scale from here. At 5 trillion, there's probably not that much left to scale. And SoftBank's clientele is looking for that kind of juice. So yeah, I don't read too much more than that into it.
All right, let's get your take in that. While it has, sold its entire stake in NVIDIA, it's still betting big on AI with investments in OpenAI as well.
Darling, the thing is that NVIDIA at 5 trillion is 1.5, that single company is 1.5 times the worth of every single listed company in China. NVIDIA by itself is worth more than the entire Chinese stock market and every company in Korea. So I guess one of the questions you've got to ask yourself is, would I prefer to own NVIDIA or every company in China and in Korea? And I think that, there's evidently some kind of AI bubble. It's hard to know when a bubble will be pricked. It's hard to know, whether it goes up another 20% before it declines. But I think it's fairly evident that most of the shares that are in, let's call it the MAG 10 now, are very expensive. I mean, take Palantir.
Yeah.
Palantir trades on 112 times sales. I mean, forget about earnings. It trades, the share price is 112 times what their annual sales are. So you've got to say that some pretty lofty expectations are priced into some of these US AI names now.
So do you think that we are nearing that bubble territory, Shane?
Well, I think it would be easier to be very bearish if we were perhaps in an interest rate hiking cycle. But at the same time that we see these, outrageous valuations, we're also looking at an interest rate cutting cycle. So, I have to balance the one against the other. Normally, stock markets don't collapse when interest rates are being cut. So it's hard to know, to be dead honest, but I would say the valuations are very expensive. The market is very narrow. I think the risks are increasing. And I would certainly have some money in reserve. I wouldn't be fully invested at this point.
Okay. All right, moving from pure tech players to fintech here at home, there's been lots of interest around Optasia pre-listing, post-listing. Grant, what have you made of it? Is it a buy?
Look, I think it's an interesting and exciting little business. I think there's a lot going on there. The fact that they're servicing big enterprises like across the continent, big cell companies who have their own data and their own tech platforms, shows you how good their IP is. And they've obviously got some secret sauce that otherwise you would expect others to replicate what they're doing. So I think it's a good business. I think they've got a reasonably good moat in their data and their algorithms. but I don't think the price is that attractive at these levels. So it's something we're sitting on the sidelines for now on this one. It is a good growth story. It looks exciting, but I think you're paying for it. So yeah, that's where we are on that.
And Shane, is Optasia one on your radar? Grant mentioning that it's a little pricey. We also have other fintech players in the space, not doing exactly what Optasia does, but in that fintech sector, the likes of Weaver Fintech, the likes of Capital Appreciation, or even Elisaka.
I think that Optasia is an interesting business, but I think it's not without its risks. On the interesting side, you've got to say they've got 120 million customers over 10 or 15 African countries, and they're penetrating a market that, is not really penetrated yet. On the other hand, the risk long term is that the cell phone companies simply go direct to these customers, because the cell phone companies are the conduit that Optasia uses, and the cell phone companies eventually can turn off that tap. The market cap's 24 billion. It's not a small business. FirstRand have bought 20%, and I think a lot of people hope that eventually FirstRand, will acquire the minorities. I don't know about that, but I would say that for us, it probably is too risky.
Too risky. All right, just sticking with you, Shane, we've been seeing, quite a few new listings and planned listings on the JSE this year. Today we heard from private security company Fidelity, which is eyeing a JSE IPO. Not too much information out, but how do you see, investors valuing a player like this, a private security player on the local markets?
What we have seen is we've seen the market absorb quite a lot of capital raises or placings. As I said, I think the Optasia placing was about 10 billion. We saw about 40 billion recently placed in Amplat. We had about the equivalent number placed in Pepkor when Steinhoff sold out. So the market clearly is absorbing these placings quite easily. We don't know much about Val Barkman's business, but it's obviously got a long track record. It's a large company. They're the largest security services provider in South Africa. They employ about 67,000 people. So it's a substantial business. And I think it is good for the JSE that companies are now, we're starting to see a trend of companies listing rather than companies delisting. In fact, the trend is larger companies listing and smaller companies delisting at this point.
All right, I'm going to give you a different question, Grant. A viewer asking about Richemont and whether it's a buy at the moment, noting that LVMH has traded a lot better recently and perhaps Richemont offers good value in the short term. Let's get your take. I mean, when the likes of an LVMH, the likes of a Kering were going through that slump over the past year or so, Richemont was still doing good.
Yeah, exactly. Richemont's its jewelry brands, Cartier and Van Cleef & Arpels, have been incredibly resilient, and they are a much bigger share of the business now than they used to be. So this is a high quality component of the Richemont business. I think it has been very defensive. It has had a run as well, though. So I think you're seeing improvement in watch sales. You're seeing spending pick up among the wealthy. So there is that support. But I think if you look at its long-term valuation and its long-term margins, it looks to me like this is probably not the best time to be buying it. Okay. Unless you're taking it sort of a core buy and hold long-term perspective. I don't think then it's not as sensitive. But in the shorter term, I probably would be a little more. I would probably wait for a better entry point if it's more of a tactical buy, personally. But I think it's a great business, and they've transformed the core of that business. It's just getting stronger.
And would you be picking some Richemont shares, Shane, or looking at, other counters in the sector? We have been seeing a bit of a rebound in LVMH over the past quarter, an improvement in Kering. Yes, sales declining, but not as bad as before.
Tarlin, so Kering sold their makeup business, and that obviously brought in a lot of capital because I think they had about 8 billion of debt up until then. On Richemont, the valuation is in the high 20s PE-wise. But the one thing I've learned about Richemont is that you must buy the dips. If you look at like 25 or 30 years of this stock's trading history, every time there's a major sell-off, all you must do is buy. And I would agree with Grant that it's an extremely well-managed company. But, like the heuristic I'm saying is in Richmond, just buy the dips. You'll make money.
All right, let's move over to some of the food counters. Premier out with results today. Double-digit growth in earnings. Softer revenue growth on the back of the dynamics playing out in terms of the commodity space. But cost efficiency is really helping it post an upbeat performance. A viewer asking if the growth we are seeing there is sustainable, Shane.
The food sector has become quite interesting and exciting, and there's been a fair bit of corporate activity of late. When investors look at these kind of companies, what they're looking for is they're looking for positive operational gearing. In other words, if the company grows sales 10, can they grow earnings at 20? So, for example, today, AVI came out, they said sales were up 5, but operating profit was up 15. And it's a similar story with Premier. That is what investors are looking for. They're looking for that positive operational gearing in the business. The other thing is that Premier said that they're going to start a share buyback. And I do think embedded in a share buyback is a lot of positive messaging, because the company is happy to buy shares in the market alongside you. So I would say, yes, I like Premier. I think it's a very well-managed business.
And putting up a Premier against the likes of a Tiger Brands, the likes of an AVI, Grant mentioning there that AVI out with an update forecasting higher earnings. Tiger Brands was also out with an update yesterday, also flagging higher earnings. So it seems like the sector overall seems to be performing well.
Yeah, certainly for the first time in a long time, the food producers are in a bit of a sweet spot. And there's definitely a lot of energy around, as Shane said. And I think it looks interesting. I mean, AVI, I would say, is already a very well-run company. I'm impressed to see that operating leverage. I mean, they are known for being a great management team. I think the greater opportunity lies in Tigers, which is now starting to drive the same kind of operating leverage that you've seen for a long time at Premier and AVI. And that's where I think there's more of an opportunity there, because they're coming from a lower base. Their margins are lower, their gearing is lower, and the efficiencies are lower. And they're now, the guy running it, Chart Kruger, is from Premier. So he's already got the roadmap of where they can go with efficiencies and operating leverage, et cetera, et cetera. And I think he's been doing a great job. So you're starting to see that come through, and I think you're going to see more of it. So I think the sector looks very interesting. I think the combination of Premier and Rhodes is a fantastic deal. I'm really excited about that. And I think of them all, I think right now at these taking into account price and opportunity, I think Tigers is the most interesting.
The clothing retailers, we've had some updates, some results that haven't been looking quite good, TFG in particular, but I think a day later or so, Pepco released an upbeat update. So the question is Mr. Price buy at current levels, 200, almost 100 Rand down from a year ago when it was trading close to 300 or so? Or is this retailer following TFG in terms of price action, Shane?
Darling, the thing that is negatively impacting the retailers is a lack of consumer spending on apparel. And part of this problem is that the online gaming companies are extracting about 70 billion per annum from the economy. And when that money is extracted, it has no velocity. It goes into the online gaming business and it's shipped to the shareholders, most of whom are offshore. Where if you go and spend something in a restaurant, some of the money goes to the waiter spends it on taxi fares, the taxi spends it on petrol, the petrol company spends it on transport. And so some money's got high velocity and it's very valuable for the economy, and some spending, like online gaming, is very low velocity money and quite harmful to the economy. And so the question you've got to ask is whether this online gaming is a permanent thing. And the loser here is clearly the apparel companies. To answer your question on Mr. Price, it's a great business. It's got no debt, and I think it would definitely be in a portfolio if I was in that sector.
And maybe let's get your take around the issue around gambling, Grant. We've had major retailers really sound the alarm around that. Even the grocery groups, Pick and Pay, one of the companies to sound the alarm on that.
Yeah, it really is a concern, and I think it's going to affect the cell phone companies, the food retailers, the clothing retailers. It's discretionary spend. We saw famous brands also saying that's affecting them, and I think the most important point is what Shane said, that a lot of that money is not even taxed here. So that money, I think there's a big loophole, and the money's just disappearing out of the system, and that's something that needs to be addressed. Possibly a bit like the Shein and Temu issue, that was a that's still a competitive threat for the retailers, but they've at least done something there to try and compete. So yeah, I do share the concerns, and there's a little bit of, you can invest a little bit in it through, Sun International if
Yeah.
you want to. You get a bit of exposure there, so that's potentially a way to hedge against it if you want to. But it is a societal, negative, and I'm not quite sure where we go with that. It's only growing. If you look at what's
Yeah.
happened overseas, it's a massive and growing industry. There's no end in sight, and there's no slowdown in sight based on global patterns. So, yeah, I think that's a concern.
Yeah. So an issue here
Darling,
around.
I
Yes.
just wanted to say, there's some research that shows that up to a third of government grants are going into online gaming.
Yeah.
And this is a highly corrosive and very negative thing. And it's very damaging in society. And this is really basically the government asleep at the wheel,
Yeah. I was
not
about to ask you,
realizing
do we
what
just
has
need?
happened here.
And I was about to ask you whether it's an issue here around regulation.
Well, it's an issue around taxation and regulation. And the government is not really acting on either. The tax rates, the taxes that they do pay are very low by international standards. And there basically is no regulation.
Yeah.
Previously, if you wanted a casino license, you had to operate in a certain area. You were limited to the certain geographical area. You had to build a hotel, a conference center. You had to do a whole lot of things in order to acquire the license. Now you don't have to do anything really.
Really a big
Yeah,
societal
there's
problem.
no job
Yeah.
creation whatsoever.
Exactly, and we are sitting with very low growth as well. All right, let's move on to the next question here. A bit of a read, but I'm going to try and summarize it. Viewer saying they're close to retirement and have had a bit of a windfall and can draw down on retirement. Initially, they thought they would not draw down, but rather leave it as a backup. On reflection, now they're thinking it might be better for a capital preservation point of view, as well as unlocking some dividends to invest it equally in 3 shares. They already hold Standard Bank, Redefine, and Spur, and just asking for your views around how to handle the windfall and the stake they already hold in those 3 counters, Grant.
So I'm reluctant to comment too much because I don't have context into what vehicle is it in. Is there a tax consequence of drawing down? If there is, maybe consider a preservation fund type of, or some kind of annuity product that helps you with the tax consequence. But I don't have the full picture, so I'm reluctant there. I would say, remember always, it's better to stay invested if you can, if you don't need the money. That's one point. But you need to look at it in the context of all of your projected needs and your current cash resources, etc. As for having all of your equity in 3 stocks, Standard Bank, Redefine, and Spur, none of them are a poor company. Standard Bank's a great business.
Yeah.
Spur is a great little business, but it's highly concentrated. For a retiree portfolio to have 3 stocks, to me, seems way too concentrated, and I think it needs to be significantly diversified, at the very least, without knowing anything else, even though there's no reflection of those businesses. And that, I think that's all I'm sort of comfortable I can comment on, not knowing more.
Anything to add there, Shane?
Look, if you're retiring, you're sort of entering a period in your life where you don't necessarily have income. And so you cannot afford to sustain capital losses. So I would say, you need a balanced fund, some equities, but a diversified equity portfolio, and then some assets like property shares and bonds that generate income.
Yeah.
But your focus is not losing the money. You don't really need to make more of the money. You just don't want to lose the money you have, because when you're retired, you can't make it back. You don't have income earning potential.
All right, and just zooming in on property, we had storage out with results earlier today. really benefiting from continued revenue and occupancy growth, driving earnings growth in the period there. Distributable income per share up 4.5%. Now, a property player that's sort of specialized, not necessarily operating in the property we know. Is this a counter you see value in, Grant?
Yeah, this is a good business. We like it. High quality business. Diverse. It's different from the other property companies, as you said. The average lease term is a lot shorter. They've got a lot of, there's the ability to reprice more regularly. And it's a good business and it's still got growth ahead of it. So we like it. Look, it has had a good run. You know, probably the valuation's looking quite full here, but we are in a rate cutting environment that does favor property stocks in general.
Yeah.
And so I think if you have it, I would certainly hold on to it. Good little business.
And talking about specialized property counters or ones that, you know, operate in a particular space, you have the likes of a storage chain. Then you have the likes of an Equitas that's just a sole industrial logistics like player. Just your thoughts around those counters that are in the property market, or playing in a property space where there's so much growth still to come?
So storage have done very well in doing acquisitions, and they have been allowed to consolidate the storage space quite effectively. The Competition Commission, I think, has looked at their acquisitions in terms of their occupation of the percent of the property market rather than as a percent of the storage market. And so they've actually established quite a high market share for themselves in storage specifically, although it's a tiny company in the property sector overall. So I think they're in quite a good position and they've got smart management, and I think it's a very good business.
All right, let's get into your stock picks. Shane, where are you seeing opportunity at the moment?
So I'm going with Old Mutual. And the reason I say this is that you must buy shares that have a good technical outlook. In other words, who's buying, who's selling, what indices are they in, and they must have a good fundamental outlook. The technical outlook for Old Mutual is, at the moment, they've been kicked out of MSCI because the share has underperformed over the years. And there's about 4 billion Rand of shares that needs to be sold between now and the end of the month. That is depressing the share price. When this technical selling is out of the way, the share price will go back up.
Okay.
So, you know, the market is giving you a chance because the share is depressed, because it's, you know, for a reason that has nothing to do with Old Mutual. And then on the fundamentals, we think Yuri's a very good CEO. The company benefits from rising equity markets, and the JSE is up 35% this year. So I think there are lots of reasons, both technical and fundamental, to like Old Mutual. And it looks really cheap. I mean, it's 7 PE, 7% dividend yield, and the company's doing a buyback.
All right. And what are you hanging your hats on, Grant?
So for a change, I'm moving outside of SA. My pick is Meta Platforms. So they've had a good pullback post their results. There's some concern around them perhaps overspending on AI capex, and that remains a risk. But I think it's comfortably the cheapest now of the Mag 7. You're getting it for 21 times next year's earnings. They have a user base of over 3 billion daily active users. I mean, that is an incredible, property that they own, and they're able to monetize that. You're seeing it come through in the margins and in the cash flows, and I think they're going to continue to leverage that user base with the advent of AI. It's helped them even further. They've already evidenced that, so I think they're going to see continuing ad growth, high margin business. I think it's a fantastic business, and as has happened before, where the markets doubted them, and Zuckerberg's, he's a good CEO and he's got it right many times, and I think you can back him to get it right again. So that would be my pick.
All right, let's leave it there, gents. Thanks so much for your time this evening. And that's all for Stockwatch today. My guests, Grant Nader from Benguela Global Fund Managers and Shane Watkins from All Weather Capital. Up next, the close.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.